Okay, we are back. I'm very happy to have on the Goldstein on Gelt Show, David Stein, who produces and hosts one of iTunes' top 10 ranked podcasts called Money for the Rest of Us. He's got tens of thousands of people who listen to the show, which is really filled with very, very good advice. So first of all, I strongly recommend it. And I also want to say, David, hello, how you doing?
I'm great. Thanks for having me.
You know, one of the things that people talk about all the time is they're always looking for the next great investment strategy. And you've certainly seen many of them in your career in finance. But the index lovers always say, you know, what are you futzing around with strategies and trying to come up with the next bet? Just buy index funds. That's what they say. Does that make sense to you?
Well, I think buying index funds makes sense, but it doesn't stop there. In other words, that's just one decision. Because where I get sort of frustrated with the all indexing all the time camp, it's not just one decision. Once you decide that you believe the markets are fairly efficient, that it doesn't pay to pay an active manager to try to outperform the market, then you need to make the decision, well, which index fund? What is your asset allocation? What is the mix? Do you adjust your exposure to different markets over time as conditions change? How frequently you rebalance? So there are a lot of active decisions when it comes to passive indexing. And so now I have always been, as an institutional advisor in my previous life, we did both. You index portions, you perhaps used active in other areas that were less efficient, but recognizing investment management, portfolio management, there are always going to be active decisions.
So let's focus on this a little bit more, because one of the questions people often ask is they'll say, well, if I'm looking at an active manager, what should I benchmark him against? And the fact is, in most cases, I think people benchmark against the S&P 500, which to me seems a little bit strange. But how do you think people should actually measure their results?
Well, with a given manager, you should look at their particular style, particular strategy. If they are a core large company U.S. stock manager, S&P 500 is the appropriate benchmark. If they're a small company manager, small cap manager, then it should be U.S. manager, Russell 2000. If they're a global manager, and so it's very, very important, because then if you don't use the right index, then you're comparing apples and oranges, and what you think is either underperformance or outperformance could simply be using the wrong benchmark. The benchmark should match the universe of investments that the particular manager fishes in. And so if it's not a good match, then there isn't a really good way to decide whether they have outperformed and earned their fee or not.
But sometimes when people will set up a core portfolio, they'll say, I've got a manager who maybe buys 5 or 10 or 15 different index funds because I like indexing and that makes sense. But each of these funds, the manager may overweight in the U.S. at some point, or in some other country, or in some specific sector. And again, it goes back to saying, what's a reasonable benchmark? Because how can you define it if the manager is using his discretion to decide where to go?
Well, if the ultimate benchmark would be the world market. So, the global market portfolio, and so an example is the MSCI All Country World Index. And so, that if it's a manager, and I used to run portfolios where we essentially invested in ETFs. And so we would use a broad-based index like that. And then if we were overweight emerging markets or something like that, you would see that the outperformance was never going to be due to security selection in terms of which stocks were in the ETFs. It was always asset allocation driven. And this gets back to another issue when it comes to indexing. If somebody is truly passive, then they should own the global market portfolio, something like the MSCI All Country World Index. The minute they deviate from that, let's say put more in U.S. stocks or something else, then they're making an active bet. So most indexers, if they go out and they're just buying the Vanguard Total Stock Market Index, if they're a U.S.-based investor, that's primarily U.S.-based stock, they're making an active bet because most investors tend to be home country biased, and they own more exposure to their home country than the rest of the world. That's an active bet on your home country. And so
let's look at the global issue a little bit more, because since I started on Wall Street about 25 years ago, at that time, people, the common wisdom was, well, put a little bit into foreign stocks because it sounded so unique in order to diversify. But now it's really obviously a big thing, and it's easy to invest around the world. But how does someone literally know where on earth to invest if, let's say, he does want to be a little more active and focused? How do you make that decision when you're an armchair investor?
Well, you start with the foundation, which would be, I start with global stocks. So at the beginning, buy the world. So you find an ETF that invests in all the investable countries around the world. And you figure out how much should be in stocks, and then you can certainly have some bonds. My approach is you want as many drivers in your portfolio as possible. But if you're going to start with the global market portfolio, an MSCI All Country World Index ETF. And it could be as simple as that. And then what I do is you start looking at, are there areas that are undervalued, that have a higher expected return? So right now, generally speaking, emerging markets are cheaper. Emerging market stocks are cheaper than the U.S. stocks, and they're cheaper than other developed stocks. And they're expected they have higher dividend yields and have expected higher economic growth. And so all things being equal, they should have a higher expected return looking out the next decade. So if somebody wanted to make an active bet, then having a little more in emerging markets makes sense. Now, there's periods that will underperform. It will be more volatile. But that's kind of you have to do. You have to look at the market conditions to see, are there areas? But at the simplest, you just own the world and you do it as cheaply as possible.
Thinking of the song "We Are the World." We're talking to David Stein, who is the host of the very, very, very popular podcast "Money for the Rest of Us." Tens of thousands of people listen to the podcast on a regular basis. Certainly worth checking out. David's been talking a little bit about. We've been focusing on index funds and maybe how to choose them and how to benchmark what you're doing. We were sort of leading towards this question of timing and being a little more specific about where you invest. On the one hand, there are so many, you see these posters all over the place. It's not timing the market, but time in the market. That's one philosophy. And then there are people who say, look around. We've got an election we're dealing with. So what would you say to a client who says, I believe in long-term investing, but I'm scared as heck, and I don't want to be in the market right now because I think it's going to be terrible. Sell out. Is that the right decision to make, or how should people deal with the fact that there really are some pretty frightening things going on?
Well, I don't think that the idea you think if somebody feels that things are going to be terrible is a terrible reason to leave the market. I believe that it is appropriate to objectively, periodically look at what market conditions are. So look at what valuations are. And if an area of the market is extremely overvalued, then it's okay to reduce your exposure to that. You do not have to ride the market up and down like a roller coaster all the time. So I look at valuations. Markets, when global recessions hit, and the U.S. is included, the market on average loses 45% around the world. And as a result, I want to look at data that looks at objectively, what are the risks of a recession? And an example of that type of data are the monthly purchasing manager indices surveys that are done around the world. And they're very tight correlation to ultimate economic growth. And so if there's a high risk of recession, it's okay to reduce your stock exposure. And then the other thing that I look at is what's called market internals. It's the level of fear, greed, momentum, and trend, because investment markets are driven by math, so they're driven by dividend yields, valuations, earnings growth, but they're also driven by emotions. When you have an internet bubble or a huge housing bubble, it's okay to reduce your exposure to get out of the way.
But how do you know the difference between a bubble and the fact that this industry maybe has grown?
Well, bubbles show up in valuation. I mean, housing, right? If unless you happen to be in a premier city, right? But I'm talking about, so maybe if you're in New York, it's hard to figure out a bubble, or San Francisco. But if you're somewhere else and you see that housing costs relative to median income are stratospheric, that's a bubble, and it's okay to make an adjustment. The same for stocks. If the PEs of stock are 50, that's a bubble. It's okay to reduce exposure. But you can't do it based on feeling. You have to at least look at it objectively, and then you make incremental steps. It's very, very difficult to get timing right. and to try to get in and out of the market. But if a good risk manager is always looking at where we are, and if risks are high, they're going to reduce the risk. Or if risks are low, then like they were after the Great Recession, where valuations got very cheap and yields on bonds were incredibly high, that was a time to take risk. But most people didn't want to because they're terrified. And
so how do you deal with that, right? They're suffering from this worry. They've just seen literally blood in the streets. How do you say, okay, but now's the time to buy and actually make people, or how do people make themselves make the right decisions?
You take baby steps. You don't do it all at once. You average in. We suffer from regret aversion. We investors, as humans, as investors, we're afraid we're going to make a mistake. And the way that you overcome that is if you happen to be out of the market, then you slowly move in. Now, if somebody is terrified of the election right now, perhaps you reduce risk. Maybe sell some of your stocks, but you don't necessarily get all the way out, because the objective data right now does not say that that there's not a high risk of recession. Valuations are a little higher than normal. U.S., I would say they are overvalued. So, I have less in U.S. stocks than I might otherwise. But you just want to look at the objective data. But it's okay to make incremental decisions. That's what risk management is. It's these all or nothing decisions that causes people to get whipsawed.
Mm-hmm. So when someone wants to make a decision or take a small step, he's listening to the show today, say, well, Doug Goldstein and David Stein are talking about little steps, and he gets all excited and he does it for a little while. A few months he watches it, maybe a year, but the fact is people kind of lose this momentum. And then they need a solution for dealing with their long-term growth. For people who aren't so interested in making these decisions and following it so closely, what's the best way for them to manage their portfolios over the years?
Well, I do an asset allocation. Understand what you can earn investing. And so one of the things I teach is that I show people that people have no idea, or some people have no idea what they can earn investing. I remember I had a guy that asked me the other day, what's a reasonable return for investing in stocks? And before I could answer, he says, it's 80%, isn't it? Because his experience was he had bought a stock and it went up 80%. So that's what he had anchored. And so before anyone can invest, you need to say, okay, here's our reasonable expectations for stocks, for bonds, based on where we are today. Not what they have done historically, but based where we are today, here's what you can earn. And once you have that, then you can choose your allocation. And if you don't want to make adjustments, then you don't. Then it's buy and hold and low fees. And the bulk of time people should spend is just finding ways to save more, because very few people get rich investing. The way you get rich is you save more and spend less, and that's how you do it. So it's the compounding. The adjusting over time can help us manage our emotion. And when you have a huge sell-off like you did in 2008, that can certainly save some angst and a lot of money that was lost. But the reality is we've been in a secular bull market since 2009, and most of those investors that rode it out and lost a bunch of money, if they stayed in, they made it back. It was a horrendous ride. It's not one I would have taken, but it's a way to invest, and it works for a lot of people if they can handle their emotions.
That's right. I think that's a big part of it, is handling the emotions. David, unfortunately, I'm very sad. That's my emotion now that we are just about out of time. But tell me in the last few seconds, how can people track you, and follow the work that you're doing?
They can. The best place is to go to moneyfortherestofus.net. That's the home for my show. Or they can find me on Twitter @JDStein.
Okay, we will put links to that at the show notes of today's show. David Stein, thanks so much for your time.
Well, thanks. It was fun.
You've been listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Doug's weekly radio show is heard around the world, but if you miss it, you can download the podcast at www.goldsteinongelt.com. The Goldstein on Gelt Show gives you up-to-date financial ideas so you can get on the path to financial freedom. If you'd like your questions answered on the air or off, send Doug an email to doug@profile-financial.com. It's your money for your future, so join Doug every week to build your wealth on the Goldstein on Gelt Show.